Hello everyone, it's Wednesday, April 16, and today we will take a closer look at the euro and the British pound charts to assess potential market shifts. On Tuesday, the euro came under notable pressure following a sharp deterioration in Eurozone economic sentiment. The key indicator plunged from 39.8 in March to minus 18.5 in April, raising concerns about the bloc's growth outlook. Although industrial production in the euro area unexpectedly rose in February, the market shrugged off the upbeat data, focusing instead on signs of weakness in confidence metrics. The euro was also weighed down by comments from US President Donald Trump, who said he's still waiting for China to make concessions in the ongoing trade negotiations. So far, there has been no response from Beijing. Meanwhile, the Chinese yuan continues to weaken amid expectations of new stimulus measures despite better-than-expected GDP growth figures released earlier this week. Traders remain cautious. If Beijing agrees to a compromise, pressure on the US dollar could ease. But most economists agree that a swift resolution to the trade standoff remains unlikely. As for the British pound, sterling extended gains yesterday, buoyed by a mixed batch of labour market data. While the UK unemployment rate held steady in February, the claimant count increase was limited to 18,700 in March, significantly below the forecast of 30,300 average. Earnings grew 5.6% year-on-year, just shy of the expected 5.7%, but the release fell to dampen pound sentiment. As a result, the pound is currently aiming for a fresh one-month high, continuing its upward momentum on the back of improving market confidence. Before we get into technical analysis, let's take a look at today's macroeconomic calendar in the UK. The Consumer Price Index is projected to have risen by 0.4% month-on-month in March, mirroring February's pace. On an annual basis, inflation is expected to cool to 2.7%, marking the third consecutive monthly slowdown. For reference, inflation came in at 3% in January and 2.8% in February. A further decline to 2.7% would signal easing price pressures, something that would be welcomed by the Bank of England as it provides more room to continue lowering interest rates. Core inflation is also seen easily slided to 3.4% from 3.5%. However, it is worth noting that the President Donald Trump's trade tariffs remain in fact, making further inflationary current in the UK this spring far from certain. The euro area is set to publish similar data. Inflation in the Eurozone is forecast to come in at 2.2% in March, while core consumer prices are expected to be 2.5%. And confirmed, this would mark a continued deceleration, and in January can give the European Central Bank the confidence to proceed with interest rate cuts at its meeting tomorrow. Under normal circumstances, such figures might pressure the euro. But with US recession fears growing on the back of sweeping tariffs, the single currency is likely to remain in demand. From the market's perspective, any policy easing by the ECB could be interpreted as a supportive measure aimed at boosting the region's economy. Speaking of US statistics, traders should keep an eye on retail sales, which are forecast to have increased by 1.3% in March. A stronger-than-expected reading could offer a boost to the US dollar. Meanwhile, industrial production is projected to dip by 0.2%. Federal Reserve Chair Jerome Powell is also scheduled to speak today. He is widely expected to stick to a cautious wait-and-see stance, reinforcing the Fed's data-dependent tapered approach. Barring any surprises, his remarks are unlikely to provide fresh support for the greenback. Let's now move on to technical analysis. On the 1-hour EUR-USD chart, pair is currently consolidating with a sideways range but is poised for potential upside. A pullback followed by a false breakout at 1.1341 would signal a buying opportunity with targets at 14.17 and 14.67. A break above these levels could open the path for an extended rally towards 15.62. At this level, I would recommend going short on the rebound, targeting an intraday correction of 35-40 pips. Short positions at 14.67 and 14.17 should be considered only in the event of a false breakout. Alternatively, if the price falls below 13.41, coming under pressure from weak Eurozone data, it could trigger a bearish move towards 12.67, where buyers are likely to step in. A break below this level would increase downside pressure, potentially dragging the euro further down to 1.1167. At this mark, it would be wise to go long on the rebound in anticipation of a 35-40 pip move. Turning to the British pound, the uptrend remains intact. A pullback followed by a false breakout at 1.3247 would generate a buy signal, paving the way for a move higher towards 33.01 and 33.44. False breakouts at either of these levels would offer an opportunity to open short positions. Going short on the rebound would be appropriate at 33.80, targeting intraday correction of 40-45 pips. In the bear case scenario, a break below 32.47 with firm consolidation would indicate a sell signal, potentially pushing sterling to 31.88 and even 31.33 if UK data disappoints. At this level, going long on a rebound would be justified, aiming for a 45-40 pip intraday correction. Long positions at 31.88 and 32.47 should only be considered if a false breakout is confirmed. Best of luck.